Thank you for joining us. So we have a great panel here today. My name is Amit Bori. I'm the CEO of the Global Impact Investing Network, or the GIN for short. And we're here to talk about impact investing and where are the deals in impact investing. Just to kick off, I wanted to say a few words. So for those of you who aren't familiar with what impact investing is, impact investments are investments made in companies or organizations with the intention of producing a positive social or environmental impact alongside a financial return. Now that definition leaves room for a lot of different ways that people can approach this. So impact investors invest across asset classes, across geographies, and across sectors. And so it's really a global phenomenon. Our membership alone at the GIN includes over 200 organizations in 32 countries and counting. And this panel embodies that diversity. We have a number of different types of institutions that are represented here today who will all be talking about impact investing and how they're finding deals and what those deals look like from their own perspective. So I think it'll be a really good discussion that'll help illuminate some of the diversity of the field. We'll talk about some of the dynamics of the market and where it's going, and then we will have room for Q&A. So please think of any questions you'd like to bring to these wonderful speakers. But we'll go one by one, and we'll actually have Amy kick us off. And just the question I'd like all of you to respond to is, what is your impact investing approach? Where are you finding the deals? And where do you wish there were deals? So Amy.
Okay, well thanks Amit, and thanks to everyone for coming to this session today. So I just want to mention just briefly the background on our firm. So TIAA Global Asset Management is the financial service arm of TIAA, formerly known as TIAA-CREF. As of 2 months ago, we've rebranded. And we've existed for over 100 years really the core purpose of serving the retirement needs of educators, those who work in healthcare and nonprofit and other service-oriented jobs. And I just want to mention that because a large part of our history in the impact space, which goes back for decades and some of the predecessor concepts around community investing, is really because of the interest of the clients that we serve. They were very interested in the early days about the social and environmental impacts of the investments that we were making on their behalf. When we think about impact investing, it's really one of the 4 core pillars of our overall responsible investment program. One is, quickly on the 4 pillars, one is that we have offered our clients socially responsible options since 1990, so we sort of came to the space that way. That's mostly public markets. We have been a long advocate of shareholder rights and proxy voting and different types of engagement. That's something that also many large institutions in the US have got into this space through that route. We also focus on ESG integration across asset classes. Impact is our 4th pillar, and we agree with Amit's definition of impact, and we would just put a little bit more of a refinement on it, in that we focus really on the private markets and real estate when we talk about our impact investing approaches. I'll just use the remaining minute or two to talk about our approach. And our approach is really defined by the mandate that we have within the TIAA complex. Our impact investor client for TIAA Global Asset Management is the TIAA General Account. So our entire strategy has to be designed to meet the needs of the general account. And I'm mentioning that because I think depending on what investor type you are, you may make different decisions about how to organize your impact investing strategy, as well as you may have different flexibility in considering the kind of deals. We did refresh our strategy in 2012 and 2013. We had done some legacy investments, and we thought it was time. The GIN had been launched, and there was a lot of work and activity in the space, so we thought it was a good time to refresh our approach. Many lessons learned. I could probably get into that later on in the discussion. But we had to make some key decisions about what were our impact themes we would focus on. We felt that it wouldn't be in our best interest for our own firm, our own investment portfolio, or the field, for our contribution to the field, to focus on a lot of things narrowly, but to go deep on a couple of sectors. And so affordable housing, inclusive finance, and community and economic development were our focus areas. We also had to make a decision about, do we consider this a separate asset class, or do we consider it approach across all asset classes, or the private markets and real estate in particular? We took the latter perspective, that this is an approach. And that also is important to know where you stand on that, because of that approach, we had to integrate our work in terms of how do we source deals, how do we underwrite deals, how do deals get approved, and we had to follow established processes for the commensurate asset classes. And so I just want to mention that that's sort of our perspective and our starting point for impact investing, but that if you're a different type of investor than an insurance company, you may be taking a different approach.
Great, thank you. And actually, just building on that approach of looking at an institutional investor and how you've built out your impact investing strategy. Next, I want to go to you, Giles. And you lead the Global Impact Initiative, and you've been advising clients on how to develop impact investing strategies. And where have you found the deals for your clients, and what have you had to do to help to construct the product to support their interests?
Yep. Thanks, Amit. And thanks everyone for joining today. As you can tell from my accent, I'm not from around here. I'm from West Hollywood. No, just kidding. Just kidding. From Sydney, Australia. So the Global Impact Initiative is an organisation that I head up that works with largely institutional clients, retirement plans in Australasia, so Australia and the Asia Pacific, to create bespoke impact investment solutions for their needs. So working with them individually. I then work with them individually and then engage fund managers, predominantly global fund managers, on actually implementing their ideas and putting that into action. How the Global Impact Initiative came around was really my background after 20 plus years working in predominantly for global fund managers, but also working in the not-for-profit sector largely as a director on a number of not-for-profit boards. Impact investing for me was a beautiful intersection of my worlds, both personally and professionally, because it's all about making money while at the same time having a social benefit and solving a social problem. And the one thing that we all know that not-for-profits are very good at is they're good at coming up with ideas, but they don't have the capital. And I'd worked in the corporate sector where there are very few good ideas, but lots of capital. So the great opportunity that the Global Impact Initiative has in working with its clients is coming up with impact investing strategies that will not only make money, but also perform a social good and a societal benefit. For those of you that don't know, Australia is the 4th largest retirement market or superannuation savings market, retirement savings markets in the world. It's actually number 4. It's number 4 behind Luxembourg, and we all know Luxembourg's just a tax haven. So it's actually 3rd in the world. And one of the reasons behind that is that we have a compulsory retirement savings system. So everyone in Australia, when they go home, they get 9% of their salary automatically gets taken out of their pay, goes to their retirement plan, and that's mandated. That's legislation. There's no way around it. The government is talking about increasing that 9% up to 15% over the next, 7 to 8 years. So the system's there. It's staying. It's growing. It's really exciting. And one of my passions around impact investing is what has been going around a little bit at this conference, but also over the last few years, is about mainstreaming impact investing. And that's about getting it out of this really nice to do, really great term and idea, and clearly there's also money under management, but it's about mainstreaming it so that people, whether they're institutional clients or whether they're retail clients, mums and dads, can get into impact investing. And something we'll have time potentially to talk about throughout the course of the panel is one of my impact investing products, which is coming to market later in the year, is being launched by a very big Australian institution. Can't go into any names, especially since it's being taped over there. But this will be the world's first actively managed impact investing strategy focused on women and girls. So we've devised a strategy that invests in companies that enhance and empower the careers of women. And we also invest in companies that educate girls. And I don't need to explain to you the benefits of all of that. I think it's pretty much a given. But about 75% of the portfolio is in developed markets and about 25% initially in emerging markets, but that will change over time.
Great, thank you. And next we'll go to Deval Patrick, and I think we've been in touch over the course of the past year or so as you were thinking about impact investing through the lens of a major investor in Bain Capital. And I'd love to hear kind of, as you were evaluating this mandate that you had of building out the impact investment strategy for Bain, how did you see the market? Where did you see the opportunities, and where do you see some places where you would have liked to have invested but didn't see the product or deal flow?
Amit, thank you, and great to be on the panel and on the apparently the not shy end of the panel. I don't know why you're letting the other end of the panel off the hook.
Later.
Yes. So a couple of observations I'd make. First of all, the firm moved in the direction has moved in the direction of impact investing, mainly because LPs were asking for the products, which I think is actually a really exciting development. These are investors in other Bain Capital funds who had gotten interested, have followed trends in consumer interests and entrepreneurial development. And frankly, the amount of capital that's moving in this direction is extremely exciting, but it is, in my view, not keeping pace with the level of consumer and entrepreneurial interest. So that's a great thing. I come to it in part from personal disposition and in part from great mentors. The personal disposition is just a frustration with short-termism. In our economics, the sort of quarter by quarter way of managing, in our politics, the election cycle by election cycle or news cycle to news cycle kind of way of governing. And I think if you really care about long-term value, particularly at a time of ubiquitous information, it's impossible to manage to the financial bottom line alone. It doesn't work. If you mess up environmentally or socially or with your employees, it will come around to bite your financial bottom line. So for me, it's not that big a step from there to impact investing, which is about being intentional about those second and third bottom lines. And then great mentors, Sir Ronald Cohen, which is a name will be familiar to many of you in this room, invented the concept of social impact bonds and was coming through the United States several years ago, introducing the concept to a number of governors, and he and I had a chance to meet, and we got modest legislation from our authority from our legislature to try this. It's a fabulous tool, which I hope we can talk about, and we did two of the first in the United States. I've stayed in touch with Ronnie over the years, as you know, Amit, and he's moved on and deeply into impact investing, and he had a lot to do with helping introduce me to the concept and to the people who are in the United States very involved. And that brings me maybe to my last observation, and then I'll yield, and I would test this actually with my colleagues here. In North America, what we saw is that there are not a lot of funds involved in impact investing, but mostly at venture and other early stage investments. There really isn't a secondary market for growth and control kinds of investments helping the companies scale. And what we're hearing from many entrepreneurs is that they haven't found a home in an equity partner where they feel their second and third bottom lines will be respected alongside their first bottom line. And that's the space we want to occupy.
Great. Well, thank you for that. And I want to pick up on the perspective that you had as governor of a state and thinking about impact investing fitting into your strategy. And I'll turn to John as a treasurer of California, a state that's has an economy that's bigger than most countries, and also from your experience as a trustee on two massive institutional investors boards, both CalPERS and CalSTRS. How does impact investing fit into your work, and how do you see the opportunities for states and institutional investors to think about this?
So we're the 7th or 8th largest economy, depending on the price of commodity, the crude oil and how it impacts Brazil, with a $2.3 trillion economy here in California. So I think if you're not thinking about impact investing, you're thinking suboptimally, right? What you want to do is you want to optimize returns. So not only do you want financial returns, but what other benefits can you provide, whether it's environmental, social, governance, spiritual. And so I think oftentimes we don't think focused. I sort of think about it as in regards to education. We all think about cognitive development, but oftentimes you forget about psychological development. So if you want to really provide an education, why don't we bring and make it more all-encompassing as to the thinking? And so I am, as the state's treasurer, the state's banker. So I sit on both CalPERS and CalSTRS, as you referenced, the two largest public defined benefit plans in the United States of America. about $280 billion plus in the CalPERS portfolio, about $180 billion plus in the CalSTRS portfolio. Henry Jones is here in the audience, my colleague at CalPERS, and Betty Yee, my colleague at CalPERS, CalSTRS, the state controller. And so obviously we want to maximize the returns for those pension systems. I'm also the agent of sale for the state's debt. So we sell the state of California. I'm not responsible for all of it, nor is the state treasurer, but over the last 30 years, we have sold $1.5 trillion in debt. And then I handle trillions of dollars of transactions each year in the treasurer's office, and we handle a short-term portfolio of about $65 to $70 billion. So there's huge opportunities in terms of the helping stir the market and creating the market. So we're looking, and I also chair 14 economic development authorities. So I sort of view this as aspirational capital. How do you use money most effectively to grow the economy, but also having impact in people's lives? Especially as you look at transformation here, as some of you who reside without the state of California, you hit the traffic and you hit the water crisis that we had. So, just you look at the roads that are going to have to develop and unfold in California with autonomous vehicles, with the water shortages. So those roads that you're going to drive on are going to be water conveyance systems, water collection systems. They're going to be tied to technology as to what the autonomous vehicles are going to be. And so it's like not only what kind of financial return do you provide for infrastructure development, but what other type of economic growth, social benefits, community enhancements, wealth and health benefits do you provide with just basic infrastructure and other types of projects.
Great, thank you. Now, we've been talking about big institutions and states and how they've thought about impact investing. And Tony, in your work with the Inherent Group, you're thinking about it from the perspective of family office, which from our perspective of the GIN, is a segment of the market that has a critical role in helping to build out this global impact investing industry, if you will. And would love to hear from your perspective. How have you thought about impact investing fitting into your work? Where have you found the opportunities, and where have you struggled to find opportunities that you'd like to invest in?
Sure. Thank you, and it's great to be here. From the family office perspective, we're trying to really leverage our unique capital base, which doesn't have a fixed tenor, to find transactions which also address our key issue areas of health and wellness, education, and the environment. And so maybe just to pick up on a few things that my fellow panelists have said, one with TIAA, I was interested to hear how you're looking at going deep in specific areas. I mean, we have that issue in spades as a family office because we have limited resources. So we have to decide where we're going to focus and how we're going to get the most leverage from our people and our capital base that we can. So we do that in a few ways. One, we have the issue areas that we focused on that I mentioned. Two, we do have some indirect investments in funds that bring specific domain expertise to us. So we'll invest in an education fund, and hopefully we can use that both to source transactions, co-investment opportunities, as well as for some information and knowledge transfer. Our overarching goal really is to demonstrate the power of for-profit business models in addressing some of these grave environmental and societal challenges that we face. And we think we can get the most leverage in doing that through our own dollars by investing in great businesses that are going to go out and innovate around products and services and then grow. But that brings us from our growth stage capital, where we're directly investing primarily in businesses that are in these the growth part of their trajectory, to larger businesses that really can propagate these ideas and these products and services. And that's what we do in our sustainability space. And onto your question about what was missing for us when we started surveying the space, is we found a lot of more passive ESG or sustainability product, which tended to either be negative screens, I won't invest in tobacco or firearms, or positive screens, I'm only going to invest in the very best ESG performance businesses. And where we've decided to focus our efforts is really in companies that are between $1 billion and $3 billion of market cap, where they're bigger than $1 billion, so they're not fighting the day-to-day survival battle, and they're willing to engage with us in the conversation, and below $3 billion, so that our position, the shareholder registry, can be meaningful enough that we can actively engage with them in a dialogue around how they can further improve their sustainability practices in their businesses. And we start really by screening for businesses that look median or better in terms of their performance. And then we work with them on whatever the material factors are in their space. So it really varies from sector to sector. And just to come on to what Deval was talking about, I really believe in the long-term power of this capital. And if folks are trying to solve a 10-year problem, not a quarterly problem, sustainability and ESG factors just make a ton of sense. It's avoided liability, but it's also going to be increasingly more revenue opportunity. It's attracting and retaining a really great and motivated workforce. So we just think it's great business, which means it's going to be better for our financial returns. We can take advantage of our long-term capital, and that's our focus and approach. I'd say the third area that we have is the foundation. In the foundation, we have no trouble finding deals. They come to us. We get lots of things, great causes that come to us in the foundation. But what we are trying to do, and if we have time later, I'll talk about some specifics of this, we are trying to really have the foundation, our not-for-profit activities, work in concert with what we're doing on the for-profit side. And that means operationally, the same person who's our analyst in energy is our program officer in the foundation. The same person who's investing in education is the program officer in our foundation. And we're finding synergies between those two, and specifically to the question before the panel today around sourcing, using our not-for-profit networks is helping us source for-profit transactions.
Great. Thank you. And I want to pick up on this point that's come through some of the comments of scale. And Giles, you spoke about how do you mainstream impact investing, and one of the things that we've been discussing as a field is that this is a tremendous potential. We're dealing with huge problems, whether it's water kind of issues in California, or we're talking about health and wellness, environmental challenges that we're facing, and these issues have been peppered throughout the conference so far. Depending on which panels you've seen, these have come up in a variety of settings. And so, the impact investing market is young. It's still, many of the sectors and verticals where people are investing are still in early days. And so, how do we think about scale in this market? And what are the opportunities that you think can scale? And so, maybe Giles, we'll kick off with you and then open up to the rest of the panelists.
Yeah, sure. So I guess I've addressed the issue from a pure investment management perspective or an asset allocation perspective. So rather than saying this is a really great idea, let's take 1 or 2% of the portfolio and put it in impact investing and you go away, investment person, and convince your investment committee this is a great idea. What we've developed at the Global Impact Initiative is solutions that sit within equities, sit within bonds, sit within real estate, where you say, we can still get you the returns. Oh, and by the way, there's a really good social benefit on the side. So in the example of the product that we'll launch later this year, we've managed to convince the client that rather than treat impact investing as this little sleeve, we can construct something that looks like a global equities fund, and it'll have really good returns, it'll be a high quality portfolio, it'll be globally diversified, and hey, it's going to have this really great social benefit of investing in companies that enhance and empower women in their careers and educate girls. So attacking it from a very different, not from a very different way, but just from a slightly different angle. And also the feedback that we were getting from prospective clients in Australia was, it takes me as much work to invest in a $10 million bond as it does in a $200 million investment. So I'd rather give them a $200 million investment to consider than a $10 million bond. So that's the way that we've attacked it. So it will very, very quickly snowball, particularly in the Australasian region, particularly in these large pension plans, once people realise that there is that ability to get scale.
Mm-hmm. Great. Maybe Amy, it would be good to get your perspective on this. Obviously, you have to think about it. You're one of those investors that is large in scale, and think about what type of ticket size makes sense for you to process through your system. And so, where have you found the opportunities that meet your requirements of scale, and what do you think can grow over time as a part of your portfolio?
Right. So I think I would just echo what Giles said about setting up the conversation the right way. So in terms of determining with our chief investment officer of the insurance company what's our annual allocation, and then working within various asset classes. I mean, we decided to go deep on 3 impact themes, and part of our strategy refresh was to kind of keep open the question of what asset classes those themes would match up to. But in the end, it's 3 years in, 4 years in now, we are finding a lot of opportunity in emerging market private equity funds and affordable housing preservation in the U.S. Through various types of fund structures. And so I guess the flip side to that is where we're not finding, we haven't been able to match up all the themes, across asset classes. But I think, one of the things that I think the field needs for scaling is greater conversations among the key participants. I think you have to take time to understand what your investors need. They need to get these deals through an approval process that's highly established. And if you go in and say there's something that's very, very non-standard, but try to convince your chief investment officer or your investment committee, it's a tall order to do that. So some things that we can give on our deal size, in terms of opportunities, so we have about 150 million to 200 million allocation for the insurance company every year. So we're doing typically 8 to 10 deals. And so we have to, we're focusing in on quality GPs, who have documentation that look like other types of funds we're investing in that don't look too different. And again, we're doing this from an insurance company balance sheet. Sure. So this is not this case for everyone. But when I have a lot of fund managers, one of the reasons we had 3 theme areas was we have so many different, you could take a meeting a day these days with fund managers coming in and pitching you something. And we just did not want to spread those resources thin. We wanted to develop expertise. And also, I think these fund managers who are newer to the space need to talk more to investors about their needs before they design product. I've had a number of fund managers come in and talk about this creative and innovative structure that they think is going to have all this impact. And I'm looking at it 5 minutes into the meeting, and we just don't take meetings like that anymore because we have to get this through a defined investment process and investment committee. Yeah.
And can you talk a little bit more also, I want to bring you in on this as well, Tony, about this notion of developing expertise. So per your comments earlier about where do you go deep, and how do you think about that with the vast landscape of opportunities, and that this is investing in a different way. So how have you guys approached developing expertise at TIAA? And then Tony, I'd love to hear how you've thought about it as well.
So it's how we chose our themes. It really does match up to where we had a lot of asset class expertise. So we're one of the largest real estate investors in the country. And so we had a deep bench in terms of expertise in that area. And so one of our focus areas has been affordable housing. So we could leverage, that bench in terms of the fundamentals of that asset class, but then on my team, build up the expertise that are really required to navigate that system. There's a lot of government programs involved with affordable housing. There's a lot of state and local municipal issues, to deal with. So we would focus on that side of the expertise, and then pair up with one of the investment members from one of our colleagues on the real estate side. So it wasn't our goal at TIAA to kind of develop an impact investing, silo, but actually our team would be working with all the partners, our investment partners. And that was also, it's been a powerful approach because we have been able to, through those relationships, have a trickle effect in terms of the organization. There still are a lot of myths and misperceptions about this field. Some of those are going away, some of those are alive and well. And so by building those relationships, we've been able to be more effective in our strategy.
Okay, thank you. And Tony, how about this question of expertise and depth? Yeah.
Right. Well, so I think this is an issue that most family offices grapple with. So how much direct investing you're going to do versus how much indirect investing. In part, taking advantage of one's capital structure means having the flexibility to move across a lot of different asset classes when they present the best risk-reward opportunities. Maybe just to talk about, so the way we do it, frankly, is we look at our issue areas that I mentioned earlier, and we try to leverage that knowledge across all of our products, whether it's impact or sustainability or our foundation. So just a quick example in the foundation space, we really like the coding school model, so coding boot camps. So this would be a General Assembly or a Galvanize. You bring in a population that's graduated college, 30 years old, making 40 grand, and after 4 to 6 months, they graduate making 80 grand with a 95% plus placement rate. What we found in our foundation is we found a local not-for-profit that was targeting a very different population. They were making on average less than 25 grand, coming from many of the most challenging neighborhoods, and graduating with very high placement rates, making $65,000 to $70,000, a not-for-profit. We love it, and we want to help them grow there and expand their capacity. So we're talking to them about making a for-profit loan to double their capacity. But at the same time, we're taking another thing that we've seen from the for-profit space in the peer-to-peer lending and working on a program where their graduates would pay back into the system, sort of like SoFi does with their peer-to-peer lending, a percentage of their earnings for the first 3 years out of school. So I love that because it's taking for-profit concepts, applying them in a not-for-profit model. We're also making a for-profit loan to help them grow, and it's a way that we can leverage our knowledge in one particular area across all of our different investment verticals.
Great, no, thank you. And coming back to this point of scale, John, from your perspective, you know, all the institutions that you're affiliated with are massive in size. How does scale fit into your work? And what have you seen in terms of the interest areas that you outlined? What has been able to scale and what has struggled to get to the scale where it made sense for the problem you're trying to address?
So I'll raise 2 points, actually follow from Amy. So I'm trying to catalyze the municipal green bond market in the United States of America. Massachusetts was first out, but as Amy referenced on some of the things, there was concerns about standardization, certification. So California has issued hundreds of millions of dollars, but as people are trying to build platforms, there's a sensitivity as to what's required and what it ought to look like going forward. So I held meetings 2 to 3 months ago with 50 institutional investors, socially responsible investors, underwriters, and broker-dealers to make sure that we create a centralized platform and that we can get the institutional players and others who are interested and others who need to emerge to make this market more effective. And so what we're doing right now is we're doing the write-up, we're doing a white paper that we'll disseminate in the next 2 to 3 months, and then actually want to do a national gathering as to what we ought to do to make sure that we have a fully developed, mature municipal green bond market. And then on the public policy side in regards to affordable housing, what we're doing in California is that I chair 2 of the state's 4 housing authorities, the ones that handle the tax credits. So TCAC, which is Tax Credit Allocation Committee, and California Debt Limit Allocation Committee. So we've done the first rewrite in 10 years of what those rules ought to look like because we want to provide for the developers and the investors a better return. So we have some legislation that was vetoed by the governor for different issues that would help catapult the returns for some of the developers at the margin. What I'm doing as the state's banker is actually I'm moving billions of dollars back into the state of California, placing it with community banks so that those monies become available for partnerships for affordable housing projects, for clean projects, for investments by people in emerging communities to create an enhanced return.
Excellent. No, thank you for sharing that. And Deval, for your work, I know you saw a need to kind of add growth equity as an option for many of these companies that are trying to scale. And what else have you seen in terms of the scale that this might look like, either for Bain Capital or just for the market in general? Yeah.
So I mean, we have focused, chosen 3 areas to focus on, and they're quite broad themselves: sustainability, health and wellness, and what we're calling community building, which is a more place-based kind of investment. I would say that represents 20% personal interest and 80% analysis about where the deal flow opportunities would lie, where we can generate a competitive return, because that's part of the target here, not to trade return for impact. And I'd say that the heritage of Bain Capital has been to be an equity partner engaged in growing the enterprise, not financially, engineering the enterprise, but actually taking it from where it is to multiples of its size, and being very intentional about that through something we call the strategic blueprint. Our notion is to bring impact in alongside that, so that we're not just investing in enterprises that are inherently impactful or are self-identified social enterprises, if you will, and then watching the run-up or helping the run-up on the financials, but actually how do we help scale both the financials and the impact? How can we have our investment and the time we give to it as an active investor actually make a difference in the outcomes on all of those bottom lines? And we've seen some great opportunities. by the way, we're in fundraising right now, so I'm a little constrained about what I can say. But I can say that before we started fundraising, and started to develop our own proprietary sourcing and so on, we've had over 100 opportunities just come in over the transom. And of those, we've been more than a little curious about a dozen of them, and half of those we're going deep in. There's a lot of opportunity out there.
Great. Well, and let's, I'll open up to Q&A in just a moment, but I want to, the last question I have for you before we do that is just to kind of like helicopter up and let's take the long view. So these are early days. We're talking about strategies and formation and a lot of work that's being done to kind of build verticals, build teams, build standards and certification. Now, when you take the long view out, I'm not sure what's doing that, but if you take the long view out, where do you see this market going? And I'll just open it up to whoever wants to dive in. But what are some of the trends and shifts that you think will really influence the nature and the development of the impact investing market?
I'll kick off. So there's two. We've spoken a lot today about institutional investors and getting more institutional investors engaged in this space. But there are two really key users of impact investing products that are really going to influence the landscape over the next 30 to 50 years. One is that millennials will inherit around about $40 trillion over the next 30 to 50 years. They don't need to be convinced about doing something good with their money. They're already there, so they're a pretty much a guaranteed buyer of impact investing. The other user group, consumer investor, are women, and that is more and more women taking over portfolios, taking over finances, whether that be just through doing it or through family situations, whatever the case may be. That is also another massive user group for impact investing. So there's some of the themes that we're certainly seeing. One of my clients is very, very interested. If you think about the standard banking relationship, the standard banking relationship is, let's get you in, we'll get you a credit card, we'll then sell you a mortgage, and then we'll talk to you about your retirement savings. What impact investing has the ability to do is actually turn that relationship on its head. So let's get you in to talk about your retirement savings. I know you don't have a lot right now because you've just started work, but we can build you a really good portfolio, and then we can start talking to them about mortgages and credit cards and all that sort of thing. So that life cycle of the client within a banking framework globally can change almost overnight once you appeal to the investment side.
Great. Yeah, please.
I would just say that I think someone mentioned earlier that impact investing exists on a spectrum. Some will say are quite comfortable with a concessionary return or no return. We've chosen a place on the spectrum where we are targeting a competitive return. And I think that as we prove out at scale that you don't have to trade return for impact, it provokes some pretty provocative, pretty interesting questions, I think, about investing generally. All investment, all business has impact, all of it. And I think disproving this canard that's out there that you have to trade, the one for the other, is a big part of what we're taking on, and I'm very excited about that.
I'd echo that. I think as you have more product that performs well in the marketplace, it just makes so much sense on so many levels that you're going to have a lot more capital flow into the space. I also would like to see, I could imagine seeing some money moving out of what's given in philanthropy every year into this world of kind of impact or sort of regenerative capital. And that in-between space between pure philanthropy and pure market returns is huge. And as the measurement systems and the vernacular around how we describe that, I think there's a lot of people that if you could really describe sort of the social return that they were receiving for giving up 300 basis points of expected financial return, would be really happy to engage in that. But the way we talk about it, the way we measure it, of course, those are very hard things to do, and it's still evolving. And you all have done, or are taking a lead on that, which I think is really which I think is really great. At the same time, there is concessionary capital that comes into the space and sometimes confuses market. What we've seen in certain sectors is folks that really love the idea of having a positive social impact and come into the space, and the valuation might be one we believe that represents concessionary returns. And I think we just have to be very careful with that, because if the full market rate of return product doesn't deliver a full market rate of return, it'll set us back in terms of attracting more capital.
Great. Amy?
Yeah, I mean, I agree with the comments that have been made here in terms of sorting out the opportunity set, sorting out the terminology and the vernacular, not to take a position on where an individual or institution should be, but just kind of harmonizing the conversation, or sort of that we're all talking the same way, because I think that is a potential impediment, to converting all this interest into activity. So that's one thing. It's something that the Treasurer mentioned. I think there's a policy piece of this that we have to look at as an industry, and I know the GIN is looking at this in terms of, you have policies that are decades old that need some refreshing, and they do play a large role in the affordable housing market. Tony, you mentioned maybe this is a reference to this, how CRA money is actually very prevalent in the U.S. That's why it's been a challenge for us to actually have some focus on the U.S., because there's a lot of CRA money flooding into the U.S., and it's challenging for institutional investors to compete and to work with CDFIs sometimes because of that factor. So there's a whole policy piece that I think we as an industry need to continue to focus on going forward.
Great. And John, your view on?
Yeah, just we all know the transformative forces for this generation are globalization and technology. So the fact that you had, in regards to green spaces, Europe 15 years more advanced than the United States of America, but you see Latin America and Asia just growing dramatically, creating incredible life forces. And hopefully the United States picks up, right? Going back to Amy, and we have political discussions and debates that need to be had, but if we're just going to catch up to the rest of the world, we're going to have to implement those at a far more rapid pace than we are today.
Great. Well, we'd love to include you in the conversation, so we'll take a few questions at once, and we'll start with James, and then I'll turn it over to the panelists after we. So please, go ahead. Yeah.
I'm James Gifford. I teach a program at Harvard on impact investing, and I'm with Tau Investment Management. Amy, my question is to you. You categorize impact in private markets, and yet some of the most impactful things you do is your shareholder activism and dialogue and voting. How do you measure the impact of your engagement and voting activities? And what advice would you have for investors who are trying to find fund managers who are serious about shareholder engagement and voting?
Hi, James. Nice to see you. So I think that all the strategies, the responsible investment strategies that I talked about, they have impact. In terms of our launching SRI funds years ago, that's changed the market, right? There's 900 plus mutual funds now. There's other types of impact. So little I, when I think big I do have the more classic, definition. One trend that we didn't talk about, it's a broader trend for the industry, is that there are an increasing number of measurement tools. So we focused a lot, right, in our industry on, can we get the right ESG ratings for companies? So we have information on the IRIS, definitions for impact. But there are a lot of groups now rating us on our ESG capabilities and our RI commitment. And I'm responsible for answering a lot of those questionnaires and surveys that are coming in, or working, with colleagues to fill those out. And I think this whole issue of how are we using our influence in the market. It's not just proxy voting anymore. It's what are the priority engagement campaigns? How are we influencing green bond market development? So I see there's a role that others are playing now in evaluating us across all of these metrics. So there's the Asset Owner Disclosure Project, the UNPRI, which of course you're very familiar with. Those types of assessments are online, kind of free, they're out there. Typically it's still tough for that average investor to access that information. And so that's where I think we can have different types of intermediaries coming and collecting that. But we know that it will be a huge focus going forward as people evaluate our capabilities to make sure we're credible, and that we're meeting the expectations of millennials and women and other client base who really prioritize this.
Sure. And so I'll pick up on the question in a moment, but just wanted to also unpack one of the acronyms that Amy used. IRIS is, that's been referred to a couple times now, is it's a catalog of metrics for measuring social, environmental, and financial performance. So essentially, it's trying to create a common language for thinking about impact. So it's a program and project that's domiciled at the GIN, but it engages a whole network of stakeholders, including investors, companies, as well as other standard setters, just trying to get us all talking the same language. So then, of course, we can manage to better performance over time. But I did, on this question of engagement with companies, did want to see if Tony or I don't know, if Giles, if you want to just add anything in before we go to the next question.
I think, so we've seen a lot of private equity firms that are really integrating ESG and sustainability into their investments, but they have control. So the challenge is when you don't have absolute control, you're a minority shareholder in a public company, how do you exert pressure? Our approach is really to be a thought partner, hopefully a productive, and have a productive dialogue with management teams, and try to convince them that we think this is good for the long-term financial performance of the business, as well as it makes a lot of sense for environmental and social reasons. I think, I think that there is a large cohort of C-suite executives who understand these issues are important, but maybe haven't yet been pushed by their shareholders to engage. And I'm again talking about the smaller $1 billion to $3 billion businesses, not the Fortune 500, that most of whom now have sustainability committees and are publishing on the topic. And so what we're trying to do really is to engage with them and even provide some free consulting and talk to them about what are really the material ESG factors, that environmental, social governance factors that will impact their financial performance over the long term.
Great. So, oh, sorry, Mr.
So I just wanted to share an effort that we've been engaged in at CalPERS and CalSTRS. So 10 years ago, when I became a member of CalPERS and CalSTRS, I asked the staff we used to have focus lists where we would target underperforming companies. And so I asked them to try to have in those engagements with those companies to diversify their corporate boards, to include more women, to include people of different backgrounds, technical skill sets, right? So it wasn't just about color or gender. Last year we added LGBT, and this year with my colleague Betty, we're pushing for people who have climate sensitivity expertise. So that's our engagement. So we're making some progress, but there are some fundamental issues as to how you work with recruitment firms, how do they access the data, how do you get people with that technical skill set appropriately placed with a board, but we're making progress.
Great, thank you. So we have next question. We have one down here. He's coming with the mic. So thank you.
Thank you. I thought, Amy, your comment about needing a common definition was interesting, given how different the definitions of impact investing on the panel were. So I guess my question is, there are various firms which are using the impact investing term more broadly, moving to public equity space, and taking what would traditionally been either a thematic investment or an ESG type investment and changing the nomenclature and making that an impact investment. So I guess I'd be interested, does it matter not having a common definition if the overall growth in sustainable investing is helped by this? Or is it a problem because we're not growing the traditional impact investing space?
So I think individuals are very attracted to this impact concept. So we've done a lot of investor surveys of our own retirement clients over the years, and we saw a shift 2 or 3 years ago when we did our survey about, we're looking for where was the most affinity, what was the most, the concept that resonated well, and should we think about how, framing the way that we talk about the space. And in the past, most retail investors in particular thought about this field as just screening out the bad companies. But we saw a noticeable shift a couple of years ago into our investors who want to think about positive impact. That's the most appealing term. I don't know. I think your point's a good one. I mean, I've framed it as there's a lot of confusion, in the space because we're using different terms. But I think there is something that the average investor finds appealing about the use of creating impact. So I think it's something we'll have to struggle with, but it could be viewed as both a positive and a negative. But I think over the long run, it's going to be tough for those who are running strategies or running funds for managers without some kind of sorting out of how we talk about it and where we all engage. So I think in the long run, it's probably best if we converge around some common definitions.
Can I just add a point?
Yeah.
Just to build off of Amy's points, one of the things that we observed that was a gap, and it's been alluded to here, is not so much in the range of definition around impact, but in the range of measurement. There isn't a gap accounting for impact. The GIN has gone a long way in this direction by trying to come up with a common language around measurement. And one of the two bits of feedback we got in talking to lots and lots of impact investors before we settled on our own business plan was, one, please don't invent a measure unique to what you're doing. Use something in common usage so that we can compare how you're performing with others. And the other was, please don't turn your companies into reporting agencies. Have a few measures that get right at the material impact, and let them be companies. Information that could be easily downloaded and easily developed for reporting purposes. And that's what we're trying to do.
Well, I also wanted to just comment on your question, because I do think it's an interesting one about how the market's evolving and how we talk about these different activities. And from our perspective, there's a kind of a macro trend towards people thinking about values in their investing more broadly. And there's all different kind of definitions and niches within that landscape but I think many of these things come from a similar spirit of caring about what your money is accomplishing and thinking about whether you want to take out the harm or really invest in the solutions to the problems that you care about. The thing where I think kind of creating the right types of kind of communities around this, and this is our perspective in running a network of impact investors, is that we do want to kind of help understand like a common practice and bring people together who are trying to accomplish similar things. And so that's one of the ways in which I think there are different strategies that may be complementary and without saying one's better than the other, but to be specific about what you're trying to accomplish and then trying to think about how do we collectively as a market kind of raise the game over time, I think is really critical because it is early days for the market. Many of the investors are new. Many have been doing this for decades, but there's more and more, the biggest portion of the market will be people who are relatively new to the market. And so how do we create a culture that is focused on prioritizing impact and over time building towards having a greater impact? And so, for the definitions, as long as they kind of create space for the right people to find one another, as well as to make sure that we're not diluting the brand of this so it continues to mean something, because it's tapped into something quite powerful for people. That's where the language becomes really important from my perspective, at least.
And if I can just add to that, for me it's very easy because my clients are saying we want the returns. So give us the returns, but then also build in the social benefits as well. But we want a market rate of return because we're running pension plans. People need to retire. They need the returns, and through that, over time, people will, as the history has shown, with initiatives between Grameen Bank and Danone and those sort of businesses, is that people are very focused initially on the investment, but what they end up being more focused on eventually is the social outcome. So it's I guess attacking the capitalists in the way that they, in talking to them in the language that they like to talk about, which is positive market rate returns. That's what we're looking at.
And maybe just to bring it back to the conversation earlier around scale, I think it's the overarching goal is to bring as much capital into the space as possible, right? Because we think it's a really effective way to address some of these issues. So having clear definitions and different products is important, I think, to your specific question. It doesn't matter. I think it does, because the more product that we have that's clearly defined, the more capital, the more people we're going to be able to find that want to invest in the space.
Okay. So we just have a few more minutes, so why don't I just, we got 3 questions in the front row, and we'll get to as much as we can. So if we'll take them all at once, if that's all right. So please go ahead.
I have a question from the other side of the equation. How do people like myself who have impact projects who are seeking smaller amounts of money, 30 to 50 million, in that range, what channels or would you suggest we pursue, or how do we create awareness for our projects for to either folks that do smaller investments? Sounds like most of your investments are much larger than that. What suggestions would you have for those of us with projects?
Great. And can we also just get these two as well? Thank you.
Yeah, I was going to ask the same question.
Okay.
We're a B-certified benefit corp in California, and we just finished a PPM. So I was going to just ask, well, what would you guys recommend in terms of good spaces to approach? And essentially the same question.
Yes. And yeah, thank you.
Hi, I'm Shiran. I'm a fellow at the Milken Innovation Center in Jerusalem, and I'm placed at the Israeli Tax Authority dealing with tax incentives model for impact investment. So my question is, do you believe tax incentives is necessary for bringing investors to build the social capital market, or do you believe only the product or the time will make the difference?
Great. All right, so we have two questions about kind of raising capital for companies, and one with a particularly small kind of ticket, as well as tax incentives. So I'll just open it up.
So I'll take that. So for those two, give me your cards. I don't have anything systemic. I just know I talk to a lot of international investors with hundreds of millions of dollars, and they're trying to place that money with projects. So they'll be happy to make those introductions for you. And tax incentives have huge implications. So as I mentioned earlier, I chair 14 economic development. So we finance things from taco trucks to Tesla. Right, and so I was able to lobby the governor last year to keep our $100 million sales tax exclusion, right, which helps Tesla and a whole bunch of companies. We're trying to up it to $350. We're trying to see if we can get a legislative author to include water manufacturing activities, but that helps advance transportation, alternative energy development in the state of California. I mentioned earlier, Betty and I sit on the Economic Development Authorities for affordable housing, so we added purple pipes, but most of the affordable housing, the deep affordable housing projects wouldn't exist without tax support from the federal government, state government. We have problems with local government and their financial positions to provide assistance in many jurisdictions today in California, so the answer is absolutely yes.
Other comments?
Go ahead. I was just going to say on the tax side, it's a very simple equation. The less the government has to pay out in social benefits, the more advantageous it would be to that government to have the tax concessions there. So we've had an example in Australia where the government, private investors, and institutional investors have got together to do a social housing project. And quite an innovative one in that there's different demographics living in the same building in terms of single mothers, in terms of working couples, in terms of families. So there's a really great kind of demographic experiment going on there. But then also at the end of the day, the government's in there to, so it doesn't have to provide as much social housing as it would have had that project not been there. So yeah, wherever there's an imperative for the government to spend less money, that is an imperative for you to ask for greater tax concessions as a product initiative. I'm good.
Okay. Well,
what he said. I'm good.
All right, well, I think we're getting the sign that it's time, so it may be a good time to stop. But I wanted to just thank all of you for joining us for this great discussion, and thank the Milken Institute, and of course, please join me in thanking these great panelists. Thank you.